Risk versus reward. Maybe you've heard that before. Maybe you've heard me say it before. It is a very important concept, very important topic that you need to understand, but there's a lot of ignorance that surrounds it. So I want to kind of talk about both sides of risk versus reward. Very quickly, risk versus reward. What is it? How do you apply it? All those nitty-gritty details. Okay, this is going to sound like a sales plug. It really wasn't meant. I do offer an entire training course on that. I just bring that up though. Yeah, I'd love for you to buy it. But just to let you know, there is a lot that goes into it. In fact, there's an entire course. But at the very surface deep, what risk versus reward is doing is basically ensuring that some sort of trade plan makes sense, has logic behind it. Again, very surface deep, but that's what risk versus reward is trying to ultimately portray and help you with, as you're, implementing your trading, no matter what the strategy is. But no matter what the strategy is, and that is what leads into, there are a couple different types of risk versus reward. Now, right off the get-go, maybe you've seen this one, maybe this is what you're aware of, but if, you're saying, well, Clay, I'm gonna risk $50 as my risk, but within the scope of the strategy, the trade plan says that I have a potential reward of, let's just say $250. Well, if you're risking $50 to make $250, people would say that is a good risk versus reward, and I would agree. Now, what happens if I told you, well, your reward is going to be, let's just call it 75, but your risk is, let's just call it much more than $75. You may be thinking, that's not a good risk versus reward. Well, it depends. This could very well be a good risk versus reward. And the biggest business model out there, the biggest kind of industry, I don't know if they're the biggest industry, but an industry that feasts upon this is what? Well, if you're thinking insurance, you would be thinking, right, let's think about what's actually going on with an insurance company. So you have a house and you have to pay what? Homeowners insurance on it, right? So you have homeowners insurance, we'll call it high. So you have high on that house just in case it burns to the ground. Hey, you are going to get, things will be taken care of. You are, you are handling risk via implementing an insurance policy. But that policy is going to be much less than what the potential, value of your home is if they have to pay, right? I mean, if you were to ever look at your homeowner's policy in terms of what you pay per month or per year, and then you look at, if my house burns down, the insurance company, they are going to be, not good, because their reward is something much more minimal than the homeowner insurance itself. But how do they overcome that? How do insurance companies actually make money? Well, what are the odds? Okay, new marker time. Let's try purple. There we go. What are the odds that your house is going to burn down? Small, right? Very, very small. Their percentage is, I probably should have written tiny there, but one and the same. Very, very small. So how do they actually make money when a house comes down? Well, they have a ton of policies out here. They have a ton of highs where people are paying them month after month after month after month after month, year after year after year after year. And the vast majority of those houses are not burning down. In fact, maybe you're tempted to say, I can't believe, why do I even pay homeowners insurance? I just paid $1,500, $2,000 for the past year. And for what? For what? Well, for your risk mitigation. But when they are collecting all of that, they are overcoming the odds where a house does indeed burn down. And that's another way that trading can be worked in terms of strategies. If you have a very high win rate strategy, then you can take getting smaller wins, smaller wins, smaller wins. But when the house does burn down, within your strategy, sure, those losses will be bigger than your gains. Sure, those losses very well may wipe out a few days, several days worth of your gains. But what's the key here? The key here is it doesn't happen very often at all, because your strategy with whatever, however it's geared, is going to compensate, overcome those instances where the house burns down. And that is the other way that you need to be aware of risk versus reward. And this just comes out because sometimes, in live trade videos, people are like, did you see your unrealized losses there? Well, first off, it's unrealized for a reason. But yes, I see them. And as I said time and time before, and I guess I'm going to say it again, when I do lose, when the house burns down, yeah, those losses wipe away many gains. Those days, or those when it burns down, not only can it wipe away many previous trades within that day, it can very well wipe away several days. And I've showed, in fact, I'll put a couple links down below where you can see my past months, and you'll notice that, yeah, there's very few losing days, but when there are losing days, you'll say, oh wow, that day definitely wiped out like the previous 3 or 4 days. Oh wow, that day definitely wiped out some previous days. But like I said, very few days. Heck, some months, as I'll put another link down below just so you see, there's not a single red day at all because it is a high win rate percentage. But again, when it loses, it is going to be bigger. But, and this is what, there is more to risk versus reward than Clay. Dude, man, I watched your video. You were just going for something very small, yet your unrealized loss is what's so much bigger. Well, putting aside that they're unrealized for a reason, and it's not really real at that point within the strategy, but just understand that, yeah, I'm well aware, but I'm also well aware that I'm using more of the insurance risk versus reward business model in terms of high win rate. But when I lose, I do lose big. And like I said, all you got to do is look at those links below, and you'll notice, yeah, few losses, but those losses do wipe away several days. But within the grand scheme of things, when you have people paying you, you're going to be able to overcome those losses. So just be aware of that. I want you to understand that there is more to risk versus reward than the stereotypical, I'm risking 50 to make 250. Again, full disclosure, that is great. I'm not saying that is a stupid thing to do, but this just illustrates there are many ways to trade, and there are many ways to implement a strategy from a risk versus reward strategy. It doesn't all have to be, well, I'm risking $50 in order to make $250. Again, that's great, but there are a lot of ways out there. So just be aware of, I guess we'll call it kind of the insurance model risk versus reward. If you are out there trading alone currently and maybe are in the market looking for a community to join to assist you in your trading or to just help you, give you another set of eyeballs, then I do have a private trading community where you can trade alongside me and other experienced traders. So what you see popping up on the screen right now is both an information link. So if you click on the inner circle one, that is going to take you to the page where I explain all the details of what exactly come with the community, both the chat room and the newsletter. And then the other image that has popped up is a behind the scenes tour where you can see exactly what is going to be contained within the community. I take you through, like I said, a behind the scenes tour of everything, and that way you'll know precisely what you are getting when you join. So definitely check that stuff out if you are interested and thinking about wanting to join a community, and let me know if you have any questions.